What's going on, guys? Welcome into today's show. Today, we're recording a little bit of a day early, actually. But today is what? I don't even know what day it is. It's
It is July 8th.
it's July 8th. I'm
When we're recording this, not when you're hearing this.
Yeah, this will be released on July 10th, and we've got a busy week of activity for reports, stock market, the Fed. We got some data and real estate news to get you guys up to speed on. Hopefully, everybody had a great 4th of July.
Mm,
We got to spend, or at least me and two of the girls came over and got to watch some fireworks, do some swimming over at your house. That was fun. Thank you for the hospitality.
absolutely. 2 years in a row now.
2 years in a row. And as Ella stated, she's making that a tradition, I guess, whether you like it or not. She's going to show up at your house.
Yeah, you're about to have four women in that house. God bless you.
These women just boss me around. So
Mhm.
I am out here taking orders and getting bossed around at home, and we're trying to act and be the boss at work. So there's a balance and a delicate dance there. But hope you guys all enjoyed celebrating Independence Day, having fun with your friends, your family. I always enjoy just taking some time to reflect on the history of Independence Day, our Constitution, all the amazing things that so many people have sacrificed and done over so many decades to be able to build all of the just epicness that this country has turned into. I mean, of course, there's always room for improvement. There's things that you can spotlight and, say there's this and that wrong with it. But you go around the world, I don't know any country that has more freedoms, more opportunity, and just more cool shit going on than the United States of America.
I couldn't agree more. That's why I love living here. As always, when you're in the midst of something that you're familiar with, you can identify things easily that you would want to be improved. But overall, especially since I travel a lot, I've seen kind of the other side of the coin a bit. And I would say that we have it pretty darn good here.
That we do. And speaking of what's going on around the world, I saw that France has got some pretty big stuff going on with their
Yeah.
elections.
Yeah. A little surprise at the end of the final round of elections there. So it's still going to be a more balanced government at the end of the day, but the Conservative Party did not win as much as they thought they were or were anticipating to win. It actually
Yeah.
kind of the opposite way a little bit.
It's interesting how that all transpired at the very, very end when they thought they had a pretty strong foothold on some stuff. But not saying that there was fraud or anything illegal going on there. But I found that interesting, right? Because they were talking like Macron was out, they got a big foothold on the more conservative party, kind of taking some ground back, and it seemed like they
Hmm.
did as much as they thought they were going to.
Yeah. That's why politics is so tricky sometimes. You can feel very much a headwind in one direction and just like that it can switch on you. So I still think Macron is going to get voted out, but not until like 2027. I think that's when they do their vote for
I believe so.
whatever, is he president? If is that what they call it? But
Yeah.
whatever his position is, they vote for that. I believe in 2020. And then also in the UK, the Labour Party, which is like the equivalent of our Democratic Party here, took control, and it was actually one of their best years and one of the worst years for the Tories, which is their equivalent of our Republican Party. So very interesting world in politics, and we keep our eyes on that just because, like anything in the market or that affects our market from a geopolitical risk. It's good to know who's in charge so you can make anticipation on what might happen in the future.
Absolutely. We saw some interesting stuff going on in our politics with a lot of the Democratic Party seeming to be fractured on, Joe Biden needs to step aside. No, we need to back him up. It looks like, at least the latest as of today, Monday, he has noted he's not stepping down. Stop asking him to step down. He's in this race to see it through to the finish, and then he goes off and has another kind of brain fart of the mouth, which is wild, right? Which is, I think, kind of validating why a lot of people are concerned about him continuing to run, at least on the Democratic ticket. And he's in it to win it. So it looks like, as of right now, they're going to have to get unified behind Joe Biden, or pull some weird rabbit out of a hat to get him out of there and get somebody else in.
Yeah, I like I said, I don't think it's gonna happen. It's never happened before. They don't really have a good replacement. I love it that people would say Gavin Newsom. It just shows how much people keep up with politics. He's the lowest, literally the lowest rated governor in all 50 states for yeah, and by his constituents in California.
Yeah.
So Gavin Newsom doesn't have a swinging chance. I don't know. I really don't think Kamala Harris has a chance at all. I think they think she does, but I don't even know what she's done during her vice presidency. She's done absolutely nothing. Um,
Nothing.
she's been a wallflower. So I uh, I think that's their best. I think that's their best bet. That's why, just like with investing, you don't dump all your chips into one basket. They dumped all their chips into one basket, and this is what they're getting for that.
Well, as of today, the House Democrats launched a united effort to block the election bill requiring voters to prove American citizenship. I know over the weekend, Washington state abolished residency requirements for voter registration. So obviously, it looks like one of the strategies of the Democrats with the mass migration that has happened over the course of their administration is for all of these undocumented and or illegal aliens to be able to have the right to vote in our federal elections. And it looks like they are going to die on that hill by not allowing the conservatives to kind of validate that law and get that in place before November rolls around.
Which is so wild to me because it's the most basic thing ever. We have age and ID requirements for way less important things,
Well,
but
here, let me. I got a list for you. You
mm,
have to show your ID. So these are activities where requiring a photo ID is apparently not racist, according to the left. Purchasing alcohol, purchasing cigarettes, opening a bank account, apply for food stamps, apply for welfare, apply for Medicaid, apply for Social Security, apply for a job, apply for unemployment, rent a house, buy a house, apply for a mortgage, drive a car, rent a car, buy a car. The list goes on and on and on. But if it's voting, that's racist. You can't do that,
no. And we should be able to go to other countries and vote in their elections too, because that makes complete and total sense.
right?
Let's just fly into countries during elections, and whoever gives us the best hotel deal, they're getting my vote.
It's pretty much what they're getting. They're getting
I
put up in
was I was implying that I didn't want to be an asshole and say
3 or
like,
4-star hotels up in New York City, and they get to vote. And yeah, it is pretty wild. So it'll be interesting. I just find it interesting. Did you see what Rob Schneider posted today? And we'll move on from politics from here. Rob
"Mm-mm,
Schneider, the comedian,
no,
who actually is in some of my favorite movies of all time.
hilarious.
He's so good. He put something out today that is kind of going viral right now. Be careful of political parties that warn of a threat to democracy, i.e., Donald Trump is a threat to democracy. While they themselves arrest their political opponents, they work with big tech companies to censor those ideologies and opinions that disagree with them. They allow men and women's sports and bathrooms. They encourage child mutilation surgeries with gender affirming care. They fire federal workers and nurses for not getting experimental gene therapies. They threaten to expand the Supreme Court and eliminate the Electoral College. They cause rampant inflation, increase the cost of groceries by 26%, allow 11 million people to illegally cross the border, and push the entire world close to World War III. And so he's obviously, getting a lot of love and a lot of hate. It's going viral right now. But I think it's a pretty fair and accurate statement. Not 100% accurate, but in a lot of ways, it's not very far off.
Yeah, and that's been the climate for the past year or a little bit more. People are just fed up with how things are going and what's getting spotlighted and things being treated like they're a majority stance or a majority issue or problem when it's not. So, yeah, it's people are fed up, and you and I included. I think they're going to, speak real. There's a website called Real Clear Politics, which is, I would say, center left, if anything. Um, but they have the electoral maps with no toss up states right now, with current polling, with Trump winning with 312 of the electoral votes and Biden having 226. If you do check the toss ups, right now it's Trump 219, Biden 198 with 121 electoral votes that are toss ups. But the toss up states are Georgia, which is probably going to be red, North Carolina, which is probably going to be red, Arizona, which is probably going to be red, and Nevada, which is probably going to be red. There's a few other blue ones: Minnesota, Wisconsin, Michigan, Virginia, Pennsylvania, potentially New Hampshire as well. But it looks like the race is going to be down to the wire, I would say. I don't think it's going to be a blowout. I would very much anticipate if he wins, it's going to be just like in 2000 when he won. It will be a victory, but it will be done from an electoral college standpoint and winning the correct states. That's what's important. We're not a majority vote. We are electoral college votes.
Yep. Well, let's take a shift over to the stock market. S&P 500 closes at an all-time high. This is the 35th time this year that it has closed at an all-time high. We're heading into more earnings coming out this week. The market seems to be rocking and rolling right now. What are
Yep.
you seeing? What are you feeling? And what does all of this mean to the average Main Street investor?
So tomorrow on Tuesday, we have Powell's testimony starting in front of Congress. And with last week's cooling labor market numbers, plus a surprise raise in unemployment from 4% to 4.1%, which is good right now.
Yep, unemployment
Um,
this week.
those are good catalysts. If we can keep getting these little nice putts forward, Powell has a good testimony, gives indication that rates probably should come down, and they are getting things under control. Move into Thursday, Friday. Not only on Thursday do we have Citigroup, JP Morgan, a few other names reporting that are pretty big, but then you have CPI, and then followed by Friday's PPI report. If we get on par or cooler reports, we have a lot of things that can push us through to continue on to higher highs. I saw a lot of end of year price revisions on the S&P. A lot of people were sitting around the 5,300 mark. I've seen, I think RBS, Royal Bank of Canada, RBC, excuse me, raised their price forecast around 5,700. I think I'm sitting somewhere between the 59 and 6,000 mark now, which
I
is
think I saw
towards,
your boy Tom Lee put 5,800. He feels like is in the bag.
yeah, I think 50, somewhere between 5,900 and 6,000 is probably what we'll end the year. I'm just guessing, but we have a lot of good momentum. And as much as I want the election to go a certain way, from a data standpoint, it's starting to look like it doesn't really matter which way the election goes because people are more focused on the actual cutting of rates. So I don't know. It's a great setup. I'll put it that way. I think that everything works out the way that it's supposed to, and an election is not as important as it normally is in an election year because we have something else that can rear its ugly head louder, with inflation sticking around and rate cuts being a potential. I think we can charge through and continue to go. And I hope I'm wrong and we blast through 6,000 and keep going because all that means is people are going to be making money. The only thing I will point out that is interesting is that the market is trading at PE levels that are pretty historically high, meaning certain areas of the market are historically expensive for where we are and what we are doing, but that doesn't mean that's now. Remember, the stock market is a forward-looking entity, so Nvidia's stock price is high now, but then in 6 months we found out, when they report, they're making a crap load of money right now. So then it all translates into another high price, and hopefully that happens again. That's why when there's a pullback in the stock or a pullback in a sector, it tends to be pretty sharp.
So, what are your thoughts on earnings coming out this week? Anything to pay attention to? Any of the exciting, companies that we've been following, making more headline news? What's on your read feed right now?
I'm excited to see JP Morgan. We do own some positions for clients in that stock. And the thing I'm excited about is they're less dependent on home loans. And even though they make good money on depositors, they are making their money from their asset management arm. And the market's been doing very well. I'm sure that their clients are doing well. And they have a lot of performance-based payments, meaning when clients' accounts hit certain what are called watermarks or high watermarks, they get an additional fee or payout for that. So I think that they're going to have I'm hoping that they have very positive earnings. I think that'll translate through to a good stock price. The other one that's interesting that we own is Citigroup, and I'm not cautious, but I'm wondering what they're going to say to make me excited. So I'm going to wait to see their call. I think is more important than their earnings. I think they're going to hit their earnings metrics, or that if they miss them, it will be by, hairs. But excited for those two mainly. Those are my two that I'm looking at, mainly because we have clients that have positions in them, and I'm interested to see what those do. JP Morgan's already been up quite a bit this year. Citigroup's doing okay, but in comparison to their peers in the financial sector, JP Morgan, I think, has probably done the best.
Tomorrow on Tuesday, the 9th, we've got Jerome Powell doing his normal talk in front of Congress.
Mhm.
Is there anything new beyond his normal, very cryptic, broad stroke comments around what the Fed is going to do? Are we still at one? And what is the probability of that rate cut in September? Has it jumped up at all? So it's still right around
As
7.
of Monday, so that does and will change daily, but around the 70% mark. So it looks like the market is pricing in 2 rate cuts for sure. I don't know how they're going to be able to stop, and then start again. I think they're going to have to start and go hard so that they can kind of navigate this soft landing of sorts that they're trying to do. So Jerome Powell, I'm looking for him to give indication that probably not at the July meeting, but things keep looking like they're looking right now and keep trending in that direction. And we keep getting more and more data that says, hey, inflation is getting more under control. We're probably going to start cutting in September. Then the question will be, okay, they started. Where do we go from here? Are they going to cut in the November meeting? Are they going to wait and surprise us? Are they going to do what I believe they did in 2015, where they're just not going to say a word, and then in December, cut or raise interest rates? Probably not raise, but cut in our case. So there's a lot of stuff that can happen. Dovish tone is what we're going to be looking for, and not pointing the finger too much and not poo-pooing in people's Wheaties. I wouldn't be surprised. I think there's a small chance that he comes out hawkish to cool the market down a bit. It's been on a tear. But he'll be choosing his words wisely.
What are your thoughts on? I saw this on the Kobayashi letter earlier today, and it talked about GDP growth estimates are dropping. The most recent Atlanta Fed estimate for real U.S. GDP quarterly growth in Q2 2024 is down to 1.7%. This estimate is down from 4.2% seen in mid-May and from 2.2% seen on June 28th. If this estimate turns out to be correct, it will be the second consecutive quarter of GDP growth below 2%, after Q1 of 2024 came in at 1.4%. Is the US economy slowing? I think obviously we could maybe have a discussion around that. And more so around, I thought this statement was interesting, which is at the current pace, GDP growth could easily turn negative as we head into 2025. The question becomes, can the Fed continue to hold rates higher for longer without a recession? What are your thoughts on this data and where it's trending? And could that be foreshadowing a potential issue around the corner?
Well, blue chip consensus has been a little more accurate based on that chart than what actual GDP has been. And keep in mind that's quarterly, so you'd multiply that number times 4, assuming you stayed the same, and that's over 6% annual GDP, which is very good. Those are good numbers. If we were reporting 1.7% to 2% every quarter of growth as a country of our size, that's pretty damn good. We don't want to. We're kind of like a new company where we don't want to grow too fast, but we also don't want to shrink. And there's a sweet spot of growth. 6% is a great sweet spot for growth for GDP. Some of those numbers that were being reported, remember, were catch-up numbers based on last year. Our GDP numbers were nowhere near that. And in fact, the year prior, we had a negative GDP print. So these are good numbers. They're not going to be 5% a quarter. That's a one-off. It's almost like people expecting the housing market to do what it did from 2020 through 2022 or 20, whatever metric you want to use, to now. Probably not going to happen again very much in the future. It was a window of opportunity, just like by 2008. It's probably not going to happen again. Not that specific event. So Yeah, I'm excited for, again, the thing this week that I'm most excited for is probably Thursday. I think that will, if we get a good Tuesday and we have good reports from the street from inflation data, plus earnings are good, plus PPI is anticipated to be low, because those are the type of things that are going to send the market kind of really up, and with a catalyst that makes sense, because like I said, it's the market does look expensive in some areas right now.
What if inflation comes in hot on Thursday?
Well, the expectation is for inflation to go up. That's the current street expectation. I don't know why, um, but that's the current expectation. So I think the expectation for CPI is up 0.1% and PPI is flat. I believe those are the current street expectations, but which can change as we with futures as we get closer to that. But I think that's what the expectation is on the street right now. And I would love to see zeros or negatives there. Those are the type of reports we need to start seeing when we get these type of inflation reports, if we're going to get 3 cuts this year. That's my opinion.
And if it comes in hotter than expected?
Mm, we would have a pullback in the market, and it would be healthy because we've been on a tear and would likely recover very quickly. So it'd be a good time to buy, in my
Well,
opinion.
would that change any probabilities of the rate cuts if inflation continues to come in hotter than expected?
Maybe from 3 down to 2, but I'm pretty certain 2 is I don't know if it's yet consensus, but it's pretty damn close to being consensus on the street. That's probably what's going to happen, and we're pretty dang close, and we're through the majority of the year, so it's easier to forecast stuff from July to September than it is January to September, right? So
Yeah, I mean, obviously, food prices are still really high. You've got, the cost of housing is probably one of the most challenging components right now in the economy for people that are looking to get into a home. The median new mortgage payment now requires 41.4% of the median U.S. household income. This was a new report by Reventure. So to put this in perspective, even at the peak of the 2008 financial crisis, this metric topped at 39.3%. We're at 41.4%. So on a
I
post-tax basis, new home buyers are spending over half of their annual income on mortgage payments. Even renting a home now costs over 30% of the median household income in the U.S. Last time housing affordability was this bad, interest rates were nearly 20%. So it's really becoming this is becoming I think a front and center issue, if it's not already for most people. I think it's starting to become more of an issue, and I'm just curious because it doesn't seem to be that the Fed has really addressed this or has too many concerns around this. And it makes me wonder, like, do they really care about real estate that much or have that much concern about real estate when it's at these levels of unaffordability? But there's no real distress in the market, right? Even though it's unaffordable, the amount of distress in the market is not there. So is it just because there's no distress, or do they care about affordability? What are your thoughts on, how this is all tying into what the Fed's doing?
um
It's pretty
You
staggering,
make
right?
a, and they think you make a pretty good point, because I don't see a reason for housing prices to go backwards,
I
because
I don't
it,
think they
it
will.
meets the 101 definition of supply and demand. There's not enough supply, demand is still fairly high, and so price has to stave demand. That's the only
Mhm.
way that you can do it.
Yep.
Um, I think the Fed wants housing prices to continue to go up, but maybe to go up at a slower pace. And I also think the thing that's going to make that metric fall in line is certain markets like probably Austin, Nashville, the southern, New Yorks, all that are all spread around down there, that people piled into, that jacked prices way, 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 way out of reasonable numbers, and now they're coming back down to where they should be, which is still higher than where they were, but not where a lot of people bought them. So you can think of it when you buy an investment at the top of a cycle, and then you have to wait either for it to get back or sell and take your losses. I think a lot of buyers, especially in markets like I said, like in Austin in particular, was one I'm thinking of. are having to take some concessions and sell because they just cannot generate the revenue that they need to, nor can they put the bodies in their short-term rentals that they need to meet their debt obligations.
Yeah, it is. It's very interesting to see how the Fed has handled. I guess not handled this because I mean they're handling this from a macro perspective, but I guess to me it shows that even with affordability, even with the cost of housing, um, prices, it doesn't seem like they're as concerned about it being that it's not bleeding into and spilling over
Yeah,
into other areas yet. And until
I
it did,
agree.
I think they would address it and look at it a little bit differently. But because there's not that level of distress that can topple other things, they're like, sorry, you can't afford it then. There's other people who can. And until that scale tips and we start seeing some real cracks in the housing market, we start seeing some real distress and blood spilling into the streets, we're not going to really, shift too much of our attention or policy to reflect alleviating that pain or pressure. So, what could be the domino that topples that is the amount of debt that is maturing over the next 12 to 36 months on the commercial side.
Yeah, specifically on the commercial side. And I'm just going to let you know the government will step in. Yeah, they'll bail it.
They'll bail it out, you think?
100%.
Because at the end of the day, what ultimately it's they don't care about the landlords and the mom and pops that potentially are going to get
No,
hit.
but they care about their lobbyists
They care about their lobbyists and they care about their banks,
and their pockets.
right?
If you don't
So
know the game, that's the game. I mean, that's how it is. You got to learn the rules so you can play by them and win. But yeah, if these big, and there's a few potential scenarios that could present itself to where, hey, we do not have the money to cover this note, and this is investor backed debt, and so we're not going to lose a bunch of money, but regular individuals that backed our building are going to lose a bunch of money. What are you expecting to do? And then the
yep,
federal government will step in and bail.
yep,
Luckily, that problem, though it is big in the grand scheme of things, like in a 2008 scheme, it's very small. It's not fraudulent. It's not, and creative things can be done to make the banks pay that back over a long period of time via profits, stock price adjustments, and paying percentages, that something. But if it got to that point, I believe they would bail them out. And as much as people would bitch and moan about that, rightfully so, because it would crash the economy, because it would crash the housing market and the stock market.
yep, which obviously nobody wants to see that. That's a net negative for everybody.
Yep.
And looking at what's going on with some of these asset classes, where the biggest stress is at, or at least is potentially mounting, is going to be in apartments and in office. Apartment vacancy rates have been unchanged in
Surprising.
Q2.
Yeah, that's surprising. I thought it was going to be big box retail.
Yep. And honestly, retail, and I got a little study on that as well. Retail is holding very strong and is at the highest occupancy of all of those, if you can believe that. Um,
I was definitely not would have been, that would have not been my first guess.
well, and there's a recent study, an article that I actually was reading this morning. I posted this in our Wise Investor Collective mastermind group on uh, a lot of the big box retailers have really shifted over to a smaller footprint model. So, like Macy's is now got a little concept store called Bloomies, like Bloomingdale's. I think Sprouts and Amazon are coming out with like their own smaller micro fresh kind of grocery store type of things. Best Buy is spinning up a smaller concept beyond their big box stuff. So I think a lot of these big box retailers are realizing that they may not need that same level of footprint to still get the quality of earnings and sales that they want to get, or they're at least diversifying a little bit. And maybe they're going to consolidate. And well, I already know this. They have a lot of brands have said they're going to consolidate a lot of their bigger footprints. And they're going to start to diversify with a little bit of these smaller footprint stores as well. So that obviously will have some repositioning in certain asset classes, certain neighborhood strip centers and plazas, and things like that. But Moody's just came out with a report on apartment vacancy rate was unchanged in Q2. It stayed flat at about 5.7%. The big one is the office vacancy rates. Those hit another record high at 20.1%, breaking the 20% barrier for the first time in history ever. So the slow bleed occurring in the office sector has really led to a steady rise in the vacancy rate, the work from home shift, working behaviors. It's a repositioning of some of the urban cores, and how big companies are maybe moving more to the suburbs or looking at different ways to accommodate their workforces. That being said, a lot of the debt that is going to be maturing over the next few years is in office, is in multifamily, and those are right now the two most challenged asset classes in commercial real estate. Yes, there is challenges in others, but those are the ones that we're paying attention to. So it's going to be very interesting to see how this plays out. But this is a new record high, and it is above the 19.3% during the S&L crisis, which was basically the other highest vacancy rate ever for office. So we'll be paying attention to that data. On the single family side, inventory is up 40% compared to the same week in 2023. So definitely some jumps in inventory. It's down 31% compared to the same week in 2019. So, we're still seeing a pretty healthy gap there in terms of inventory. Transactions a lot slower. The velocity of what deal flow and assets trading is just kind of really
Drying up.
dried up in a lot of ways. Yeah. Um, but inventory should be above 2020 levels for the same week next week. So we'll pay attention to that. Um, and if you think about it this way, back in June of 2023, inventory was down almost 54% compared to that 2019 level. Now, as I mentioned, it's at 31%.
Mm.
So gap to more normal inventory levels is slowly closing. And obviously, it's going to be interesting to see what the Fed does, and how real estate ties into any of their policy, their rate cuts, and gets any attention or not. Right? Kind of like what we've been talking about here in the previous minutes. As we close out today, I got a couple questions for you. These are two that came in from a couple different listeners that I thought were interesting. We get a lot that come in every week, but I figured these were somewhat pertinent. For someone who has a child, or somebody that is looking to enter the stock market for the first time, what is the best piece of advice you would give somebody that is hoping to enter the stock market this year or in the coming months?
I would tell you to not be afraid, but also to let you know it takes some level of skill because there's thousands of companies to pick. So, are you doing fund focused or are you doing individual stocks? If you're going to do it yourself, I would recommend doing just some ETFs. You can always reach out to me and my team, and we can help you do that. For kids, we like to use UTMA or UGMAs, which are Universal Transfer to Minor or Universal Gift to Minor accounts, which is just like a brokerage account that has custodial privileges for the parent. There's a trigger age between 18 and 25, depending on the state that you live in. And when that child reaches that age, that account transfers ownership from yourself as the custodial owner to the now adult child. And that money is then usable for anything. You can also use that money for whatever you want while the child is growing up, and you don't have to use it for education expenses specifically, or has to be for higher education, anything like that. You can use it for sports. You can use it for really anything.
That's
So
cool.
UGMA, UTMAs are very good for kids. Getting into the stock market is definitely something, especially like I said, if you're picking individual stocks, that is a good idea, but it's hard to pick the individual stocks. So if you want, you can text X-Ray to 844-447-1555. Me and my team will reach out. You can get on a phone call with me. We can go over it together.
And as we wrap up today's question, this one came in anonymously. I don't know who the person is, but they just noted, I inherited a couple $1,000,000 from my grandmother, and I'd like to put $1,000,000 into the stock market. If you had $1,000,000, which stock or investment vehicles would you invest in for the next half of the year?
Of the year. Um, I would, depending on your age, then your risk tolerance, I would definitely put that money towards a majority equity focus portfolio. I would do a blend of ETH funds and individual stocks, and I would let that thing grow, and I would trade it and love it and water it and hug it. Those are the type of accounts where it's kind of more fun. When you get over the really $100,000 mark is good, but when you get over 1 million, I mean, I have a client that he inherited. He's probably listening today. I can't say his name because I'm going to talk somewhat a little bit about his account, but he inherited some money from a family member, and it was a qualified account. And so that qualified account has to be liquidated. That's an IRA, has to be liquidated within a 10-year period of him getting it. We took out about $250,000, and we've already made back about $120,000 of that 250,000 we took out. It's a good problem to have. We'll have to take out more money next year, but just to show you what a properly allocated portfolio can do. That portfolio is over 1 million in the low millions range. And on most days when I look and the market's up and it's doing well, it's up $8,000 to $12,000 a day. And then when the dividends get paid on that, it's a couple $1,000 every quarter that gets reinvested and gets put back in. So those are fun portfolios for us to work with. You can also reach out anonymous. You're not required to give money to anybody, but we build a financial plan for you, kind of show you what to do, why we would do it. We back that with a third party based report. And we also hold GIPS, Global Investment Performance Standards. So all of our returns are audited by a third party. It's the best way to look under a hood, I think. It's free, no obligation, and it really lets you know what you can do.
I love it. I love it. Two good answers there. Two great questions as well. As always, we appreciate you guys tuning in, tapping in with us to keep your pulse on the market. Most importantly, just to be involved in conversations that are sharpening the tools in your tool chest when it comes to your wealth building, tapped into policy, politics, what's going on in the stock market, what reports, what data is coming out. Things that at the end of the day, you just be involved in, whether it's CPI reports, it's GDP, it's unemployment and jobless claims, right? Which is also a report that's coming out on Friday. Non-farm payrolls, consumer spending, all of these things are important. What's going on with, building permits and construction spending, housing starts, mortgage apps, interest rates, distressed, data trends on the housing market. These are just things that allow you to have the closest thing to a crystal ball, right? Which is just to have insights and data that give you a little bit more clues about where things were, where things are, and maybe where things are headed. So that way you can continue put your best foot forward in achieving your financial goals. And that's really all we like to do when we have these conversations each and every week, right? Is to discuss the things that we think are going to put you in a little bit more of an equipped position to make better financial decisions when it comes to your wealth building journey. So we always appreciate you guys tuning in, supporting the show. One of the best ways you can do that is one, subscribing. Two, take 60 seconds, leave a review, share this out with somebody that can get some value from it. Of course, if you guys want to connect with Ryan and his team, that's X-Ray. Text the word X-Ray to 844-447-1555. If you're an accredited investor, you want to get on my deals list. That's essentially just my list of accredited investors that if and when I invest in a deal, I send it out to my list. And that's something that you guys can get access to. I only share that information with the people on that list. And you can text the word deals to 844-447-1555. That being said, thank you guys again. Until next week, keep investing in yourself and your wealth on your march to $1 million and beyond. We'll see you guys in next week's episode.
Cheers, y'all.